Hey, Simple Passive Cashflow listeners. Today we have Tom Wheelwright, CPA and author of this book, Tax-Free Wealth. If you guys were kind of following along what the club was doing these last month, we did Tom's book's Tax-Free Wealth for the book club. You guys can check that out at simplepassivecashflow.com/tax, where we kind of go through in a mastermind format. And by now the mastermind should be open. So if you guys are interested in applying for that, go to simplepassivecashflow.com/journey. But good morning, Tom. I really
Good morning.
appreciate you jumping on here.
Absolutely. Happy to do it.
So I read the first Tax-Free Wealth that came out. I don't know when that is, but you recently introduced this newer version, released 2008, I believe, because of the new tax changes.
Yeah, originally the first one came out 2012. We redid it for the 2017 changes in the tax law. Just came out a couple of months ago.
Yeah, so I think the biggest takeaway that I got, and that the book brought about in me was you talked about 4 different types of income, right? Do you want to kind of go over that for the folks? Because that really cleared things up for me.
Well, so the key is that how much tax you pay depends not just on how much income you have, but how you earn that income. So, if you look at an employee, if you earn your income through wages, you're going to be taxed differently than if you earn that same amount of income as a professional investor or a business owner. Okay, so really we think of 4 different types of income. We have really self-employment income, we have earned income, we have portfolio or capital gain income, and we have tax-free income. So we really have different types of income, and that determines a lot on how much tax you're going to pay.
So I think a lot of people hear about, you don't want to really flip houses because then they'll be, taxed at a higher rate. You rather hold on to an asset, like rental property, for example, and it gets taxed at a lower rate, the long-term capital gains. You want to kind of explain the differences just in the numbers of those two?
Yeah, well, so let's just kind of walk through. You could have an investment in a single family home, and you could be taxed anywhere from the highest possible tax rate to absolutely no tax at all. So if you started with the highest tax rate, which would be it's actually self-employment income. So when you're flipping houses as a self-employed person, then not only are you paying tax on the income tax, but you're also paying self-employment tax, up to 16.2% on that. So you've got 37% federal income tax plus 16.2% of self-employment tax. So that's the highest income possible. That's you're flipping houses. If you then take that and you decide, okay, but I'm going to form an entity, and in this case it'd be an S corporation. So an S corporation, the dividends or the distributions from an S corporation are not subject to self-employment tax. So you can effectively significantly reduce that 16.2% all the way down to somewhere in the neighborhood of 5 or 6%. So that kind of turns it from self-employment income to ordinary income. If you hold the property as a rental, now what you've done is you've taken it from that 37 plus 16, say, 50% plus, and you take it down all the way to 20%, okay, because capital gains are taxed at 20%. But then if you just hold it and you do a like-kind exchange with it, and we call that buy, borrow, die, where you buy the property, you hold it, you hold it, and then in order to get cash flow from it, you actually borrow from it. The depreciation on it is going to offset the cash flow deductions, and what will happen is that when you do a 1031 exchange, which is just trading it for another property, you should keep doing that. Eventually, you're not going to pay any capital gains tax. Eventually, you die. When you die, all the tax goes away by function of the law. So what happens is you can go all the way from a 53% tax rate to a 0% tax rate, depending on what you do with the property and how you deal with it when you sell the property.
Right. So 2018 kind of brought about a whole bunch of changes in the tax law.
Did.
And, kind of the first one here that I think, by going through those 4 categories, something that really became apparent was the 21% corporate tax rate came down, right? And that kind of repatriatized a lot of
Right.
money. So how does that work? I mean, there's sort of a game between, you got to figure out where you fall in that 21%. If so, it makes more sense to get taxed from the corporation standpoint.
Well, so you really have a choice when you form your entity if you're going to be taxed as a corporation or a pass-through entity. And if you're flipping real estate, you're probably not going to want to be a regular corporate entity, because you want to be able to take the money out of that entity to live on, to do other things with, maybe to do some investing with outside of your flipping. Excuse me. So you probably don't want to be what we call a C corporation. That's the 21% bracket. The reason you'd want to be a C corporation is if you're going to if you're in a business where you're taking all the money from your business and reinvesting it, and eventually you're going to sell the business. So you're not really taking money out, because the problem with that 21% rate is, yeah, you get 21% now, but any money that you take out gets taxed a second time. So you're still in a high tax bracket if you're in a C corporation, if you're pulling the money out of the company. So what we want to do is instead of being a C corporation, if we're going to pull money out of a company, we probably want to be a pass-through entity like a S corporation or a partnership. And then if you're investing in real estate, so you're a long-term hold, we don't want it even in an S corporation. We'd like it to be in a partnership, an LLC tax as a partnership, or that's really the best one. You could be an LLC tax as a sole proprietorship and be okay too. We probably want to stay away from that corporate form though for most investment real estate.
And would you be able to explain for the folks the whole pass-through entity thing? Because I admit,
For sure.
I don't really understand it, and I've heard it a lot of times, and I'm to the point where I'm just like, well, I'm just going to give it to my professionals, and they're going to figure it out. I mean,
well, it's actually pretty simple. So there's 2 types of companies. Okay, there's taxable companies and there's pass-through companies. A taxable company pays tax inside the company itself. So if you earn $100,000, the company pays tax on $100,000, and that's that 21% rate. Then when it distributes money to you as an individual, you pay tax again on dividends, typically in a 15% tax bracket. So if you had $100,000 and you paid 20, let's say, make it easy, you pay 20% tax on that, you'd have $80,000 left over. You distribute that $80,000, you're going to pay tax a second time on that $80,000. Okay, so that's the double tax of being a taxable entity like a C corporation. The pass-through, the idea is that it only gets taxed once. So rather than the corporation or the company paying tax, the owners pay tax. Okay, so in other words, the taxable income passes through to the owners, and there's no tax at the corporate level. The owners pay tax at their individual tax rates. What happened in 2017 is we got a new deduction for pass-through income. And that new deduction is effectively equal to 20% of the pass-through income. So instead of having a maximum tax rate of 37%, our maximum tax rate is 29.6% because of that 20% deduction.
Mm-hmm. So the new tax laws, they kind of brought about a lot of changes. In my opinion, it simplified things a lot. And for us in real estate investors, and especially passive investors, a lot of good changes. But I think a lot of miscellaneous deductions got taken away that are kind of killing the average W-2 worker. What are some of those things that got taken away from the people that probably need it the most, right?
So you'll love this. So all investment deductions went away unless you're in real estate or in oil and gas. Okay, so if you're invested, like you're invested in the stock market and you pay a stockbroker, that deduction is no longer there. You no longer, if you are an investor, you don't get to deduct your tax preparation fees. You don't get to deduct your employee business expenses. You don't get to deduct moving costs if you move from one city to another to take a new job. You only get to deduct a portion of your state income taxes. A lot of deductions went away, and in exchange, we got a standard deduction of $24,000 for a married couple, or $12,000 for a single person. So what happened is that, yeah, the employees really got a lot of deductions taken away, but the real estate investors did really well, because what we got in real estate that's most important is bonus depreciation on real estate.
Yeah.
Which is huge. I mean, consider that if you could buy $1 million property, put $200,000 down, and end up with a $300,000 deduction the first year. So you put 200 in, borrow 800 from the bank, and get a $300,000 deduction the first year. So you're basically getting a deduction equal to 150% of your investment in the first year.
Yeah, it's for people who don't realize, if you put in like 100 grand as a limited partner in a deal, you're seeing anywhere from like $30,000 to $60,000 coming back in depreciation just in year one.
Actually, this year you should see a lot more than that. If you put it in 2018, you should see depreciation coming back as much as 150,000 for that 100,000 you put in.
So that was, I think, in 2017. I went in a deal like in December. Of course, we didn't make any money, but
right. So you could have gotten bonus depreciation in 2017 if you'd done a cost segregation.
Oh, so that was one of those rules that kind of went into effect and then didn't really kick in until 2018.
Actually, that rule kicked in September of 2017. So if you had invested in a deal in December of 2017, you could have gotten that tax benefit.
Wow. Well, we'll see this year in the next coming few months.
Absolutely.
So you kind of talk about in your book about, there's a spectrum of good CPAs and bad CPAs, just like good lawyers, bad lawyers, good engineers, sure, good doctors, bad doctors. Of course, you don't want to work with the H&R Blocks and those folks of the world. But for the layperson like myself, we always ask, like, well, how the heck do we know, right? So some of these, the concepts that you talk about, the little more exotic things, maybe we can talk about that a little bit to give the folks a little bit firepower to kind of ask the right questions to see if you get the deer in the headlight look from your perspective CPA. So I guess the first one you kind of mentioned that the oil and gas investments.
Sure.
Maybe talk about that a little bit. Why is there such a deductions there? And this would be a good one to tell that CPA.
Well, so here, really what I'd be looking for in a CPA is, how do they see the tax law? Unfortunately, most tax preparers and tax advisors, CPAs or not, are pretty much scared to death of the tax law, and they're scared to death of the IRS. If your CPA tells you not to take a deduction that's a legitimate deduction, like a home office deduction, for example, that's a legitimate deduction, I would just say next. Let's look for another tax guy. If your CPA is afraid of the law, and the way you tell is you're going, okay, so what's your view of the tax law? If I'm going to pay less taxes, how do I pay less taxes? And the answer to that is, all you have to do to pay less taxes is change your facts. You want to change your tax, you change your facts. That's what I'm always saying. And because what happens is that taxes are very facts and circumstances, and something that's not deductible for an employee may be deductible for a business owner or an investor. The tax law is literally a series of thousands of incentives for business owners and investors. So it's really, do you look at the tax law as a positive, that this is a roadmap for reducing your taxes? Or do they look at it as, oh, we need to protect against an IRS audit, and that's what we need to do above all? Okay, if your tax advisor is afraid of the IRS, you need a new tax advisor, because a good tax advisor will never be afraid of the IRS.
Right. Yes. Some of the good example of that is like myself. And, before I was just a passive investor, but then I started to do this podcast. start to bring other investors with me. And now whenever I travel anywhere, I pretty much can have I just shoot it out. I mean, I like to see you guys and hang out with you guys, but part of it is to write off my flight, to be honest, you know. I mean, they're business trips, and it's the way I've changed my facts around, like how you say.
Well, and that's it. So, really, I just be asking, so how can I reduce my taxes? I mean, I think that's the most important question you can ask and if they say, well, you should, here's an answer I actually hear a lot, that I hear a lot of investors get. Well, you're making a lot of money, so you should just be happy that you're making so much money. And if you want to pay less tax, you should make less money, which is, by the way, the dumbest answer ever, okay, for that question. Because the more money you make, actually, if you make it the right way, the less tax you pay. So the more assets you have, the less tax you pay. If you're earning your money, if you're earned income, like an employee, yeah, the more money you make, the more taxes you pay. But if you're making money as an investor, then the more money you make, you actually should pay less and less tax because you have more write-offs. Like the oil and gas, for example. These days, you can invest $100,000 in an oil deal and get a $100,000 deduction the first year. That's how big the deduction is, because the government is saying, look, we recognize that there is risk in you investing in that oil deal. And because of that risk, we're willing to share that risk with you. So you're just partnering with the government. The government's saying, look, we'll give you 40% tax benefit. You put up 60%, we'll put up 40%. And that's really what's going on.
In your book, you said that if you're investing in real estate deals or going into these type of investments where they're tax advantage, you should be paying like about a third of what the average person is paying in tax. And I'm just going to tell you hit it right on the ball with my 2017 return. I think I paid like 12 or 14% effective. So you're right on there. And it's exactly because of all the stuff we've been talking about.
Right. Now, if you're a serious real estate investor, I mean, the book's called Tax-Free Wealth, right? Not tax-reduced wealth. And literally from the time you start real estate investing, anywhere from 3 to 4 years out, you should be paying zero tax.
So another, a lot of guys, they come to me and, they've got like 300-400 grand in their 401k. And I kind of talk them into with taking that out and start investing in that on their own. One of the biggest, obviously that's going to blow up their AGI and push their taxes very high as ordinary income. One of the ways that we try and get that down is with land conservation easements. Maybe we can talk about the little bit of that, just so people are armed when they go talk to their CPA to see if their CPA knows a thing or two about that.
Yeah, let's get to that. But let me give you a really cool example. I was talking about bonus depreciation earlier. And let's say you took that $400,000 out of your IRA, okay? So you take $400,000 out. And so you have $400,000 of taxable income now, right? Plus a 10% penalty. Okay, but let's say that you took that money and you went and borrowed from the bank 80% loan to value, and you bought a $2 million building. Okay, so $400,000, you should be able to buy a $2 million building, right? So on that $2 million building, you should get a deduction equal to $600,000, 30% of that. So that $600,000 deduction will offset that $400,000 of income. On top of that, it will offset other income that you might have during the year. And I've run these numbers a number of times, and most people are actually have a net tax benefit if they pull the money out of the IRA and fully invest it in real estate with adequate leverage. So you can actually make money tax-wise by pulling the money out of the IRA, even though you've got that 10% penalty, because the bonus depreciation should offset all of that income. So you don't even have to do a conservation easement. So a conservation easement is basically a tax shelter, and it's a allowed tax shelter. It's a lot of CPAs are scared to death of them because there's very serious reporting. There's potential penalties from them. They're legal. They're absolutely legal. And you have to be a little careful with who does the conservation easement, because it's a risk that if they do the conservation easement but they don't do it right, you might not get any deduction, okay? Or you might get a severely reduced deduction. So just like any investment, you have to do your due diligence and make sure that you're getting in with somebody who's doing it well. But a conservation easement certainly is, and it's a charitable deduction, by the way. So it goes on Schedule A. It's a charitable deduction.
It's above the line for
it's below the line.
Below
It's a below the line deduction. So it's an itemized deduction, and I don't have any issue with them, but I will tell you that investing in the real estate with a sufficient leverage and a cost segregation is much less risky and will get you more benefits than a conservation easement.
All right. So I'm starting to like get out of multifamily apartments a little bit. How does the bonus depreciation look for if you're looking at apartments compared with mobile home parks, or maybe like an assisted living facility that's a lot of equipment?
It's all good. I mean, it's just all good. So what you have to do, and this is a term that, by the way, you ask about, when you're talking to your CPA, okay, talk to them about cost segregations, because a cost segregation is the way you get that bonus depreciation at its maximum level. So you really have to do a cost segregation. All it means is that you hire a professional, typically an engineer and an accountant combined, and you hire a professional, go in, do an analysis of your property to break it down or segregate it into four types, really the four things that you paid for. You paid for the land, which gets no depreciation. You paid for the building, which gets a little bit of depreciation. But where it really gets exciting is you also paid for the land improvements, like the fencing and the lighting and the landscaping. And then you also paid for the contents, like the window coverings and the flooring and the cabinetry and all of that kind of stuff. Well, the window cap, the contents and the land improvements get bonus depreciation, which means, and typically that's about 30% of your cost, somewhere between 20 to 30% of your cost. Well, bonus depreciation is 100% deduction the first year. So that means that between your land improvements, if you do a cost segregation between your land improvements and your contents, you get a deduction up to 30% of the purchase price of that property, whether it's assisted living, commercial property, multifamily. Cost segregations are really underutilized, and they're a very important part of tax planning.
So I'm on board with you on the whole cost seg, and if you guys want to get my my page in that, simplepassivecashflow.com/cost seg, SEG, and you can read more about that. But so Tom, I'm on board with the whole cost seg and going into deals, but there's a lot of investors that just picked up the Rich Dad Poor Dad book maybe 6 months ago, and they're not quite ready to go plump down 50 grand here and 50 grand here as a passive. What are some other things other than the land conservation easements and the oil and gas that W-2 workers can get in to whack that HEI down?
Real estate, oil and gas are the two best, for sure. Some kind of real estate, some kind of oil and gas. A conservation easement's really a real estate investment. Okay, so when the other, of course, the third, there's agriculture, there's businesses, there's research and development in businesses, but somebody who's an employee who's just starting out, honestly, the best thing they can do is get educated. So before you ever start investing, have a huge recommendation. And that's why I like podcasts like yours, where you're giving people the education, and the more educated they get, the lower their risk is.
Yeah, I guess if you guys are kind of, still in that infancy stage, not ready to pull the trigger or anything, I recommend maybe just putting a little bit of cash in your infinite banking system just to buy you time, and at least you're doing something. But yeah, just like Tom says, you got to get off the bench and start putting money in deals. So there's this is my question here, Tom. As a syndicator, can we write the PPM in a certain way where we instead of giving our investors distributions, that we can call it return of capital, so it doesn't come up as returns? Is that
Well,
something we can do, or create
what
it?
really happened? Okay, so this goes back to your question about what is a pass through, because your deals are pass through deals, which means that whatever net income there is, regardless of the distribution. Okay, so you kind of have to separate out distributions from income, and that's a hard concept. You just have to think, okay, distributions are not taxable, period. Distributions are not taxable. So you don't have to worry about distributions. What you're worried about is, how do I reduce my net income? And the way to do that is a cost segregation. The way to do that is depreciation. So the depreciation is a non-cash deduction against your cash income. So if you had cash income, for example, let's say your cash flow was $10,000 and you had depreciation of $10,000, then even though you distributed $10,000, the tax would be zero, because your net income is $10,000 of income minus $10,000 of depreciation. So the key is your deductions. Another issue that I think syndicators don't always take advantage of, because their CPAs don't understand it, is that we have, in 2014, we got new regulations on classifying something as a repair versus a capital improvement. The difference is a repair is deductible. A capital improvement has to be depreciated. So anything we can change, we can deduct as a repair is a way to offset that income that would otherwise be taxable on their K1. So what we really want to do is we want to maximize deductions through repairs and depreciation. And then the other thing to remember is that in order to continue, let's say you get this big bonus depreciation the first year, well, that means next year you're not going to get the big depreciation. So real estate investing has to become an addiction. You have to do it over and over and over again. Because if you just do it once, then year two, you're going to hit with taxable income. But if you invest again in year two, you're going to get another big tax deduction. You invest again in year three, you're going to get another big tax deduction. The more you invest, the less tax you pay.
And that kind of flies in the face of that age-old advice: buy and never sell, right? That's what a lot of people operate on.
You can buy and never sell, but what you have to do is you need to still take the money out. So that might be refinancing it, right? Refinancing, debt's not taxable. So, this is the buy, borrow, die strategy, right? So you buy something, you can hold it as long as you want. But then in order to take the cash out, you borrow, you refinance the property, as you build up your net operating income, or your cap rates go down, you can then refinance that property. You can pull cash out. That's not taxable cash, okay? Because it's debt, and debt's not taxable, because eventually you're going to have to pay that back, right? So you just you refinance over the years. You can actually hold it. You can hold it until you die, or you can sell it, do a 1031, buy a new property, and do that again. But the reality is, it's really just how you're doing it as you do it. Just don't be selling that and paying tax on the gain. That's crazy.
All right. So with normal depreciation, you're taking it out in 27 years or so.
Right.
But with the bonus depreciation, how does it come out? I know you get a big chunk in the first year, but then the first 5-10 years then?
Well, with bonus depreciation, you get a big chunk the first year, and then it's 27 and a half years for the rest.
Okay.
So you're taking, instead of 5 to 10 years, you're getting it in 1 year. That's what bonus depreciation does.
So again, if you're on that shorter timeline, you're repositioning a property 3 to 5 years, and that's optimal to kicking that can down the road.
Well, like I said, as long as what you're doing is the way you're getting the money out is either borrowing it or do a 1031 exchange, then you're not going to have to pay tax anyway. Now, even with bonus depreciation, here's some interesting numbers. Let's say that you sell a property in 2019, and you're going to buy another property, you actually may be better off paying the tax, not doing the 1031, and buying the new property and taking bonus depreciation on the new property. So a 1031 for the next few years, while we have bonus depreciation, may not give you the best tax consequence.
Right. Got it. So kind of switching gears a little bit for, we're in a kind of a bull market here. People have primary residences where it's gone up in value, well above the $250,000, $500,000 gain. What options do they have? Or is a delay sale trust something they want to use in the situation to shelter that tax?
You know what? The challenge is you're delaying the cash, right? So the question, for me, I want the cash now. So I'd rather pay the capital gains. It's not that high of a rate. It's going to be 15 to 20%, and take the cash. But here's the thing. Let's say that we sold the house, and let's say we sold it for $700,000 of gain. So we have $200,000 of capital gain, right? We're married. So we have $200,000 of capital gain. But we take that $200,000 and invest it in investment real estate. The depreciation on the new property is going to more than offset the $200,000 gain. So recognizing the gain is not necessarily a bad thing.
Right. But then that's predicated on going into deals, guys.
It is. That's right. It's all predicated on investing. The more money you invest, the less taxes you pay.
So these guys got good questions. One more question here on what do people do for their health expenses? A lot of people are using the high deductibles to get the health savings accounts. What's your best tax advantage ways of kind of people to pay that medical expense?
Well, there's two ways. I mean, an HSA is a legitimate way because it's pre-tax, right? So you can get the deduction. The other way is if you have a corporation that, let's say you're the only employee of that corporation, you can do a medical expense reimbursement plan and you get the whole thing deducted at the corporate level. So, an HSA or medical expense reimbursement plan are really the two ways to take care of that medical expense. Got it.
And I think the last question here is more of a personal question. So if I'm going to get a lot of these, 2018 is going to be a big loss year on paper for me. It sounds like if your prophecy is true.
It could be.
So I'm not going to be able to take all those losses. They're just going to be piling up in a passive loss bucket. That's my understanding.
If you're passive, then they're going to pile up. But you know what? A good tax advisor should be able to get those, make those available for you. There are ways to make passive losses available. It's not the end of the world. I mean, it carries over forever. So, let's say you got a big loss this year. Next year, you don't have that depreciation, but you've got that loss carry forward. And so it offsets the income, and you may offset your income for the next 5 years.
Right. So I think a lot of people are in this category where, and I'll have them go pull up their taxes and we go look at that page and where they show how much passive losses they have in their bucket, and it's usually like 200, 400,000, and they just can't possibly take it. Partially because it's, none of the husband or wife isn't a real estate professional.
But that is more a function of your tax advisor than the tax law. I will tell you, I have clients who are doctors that are using their passive losses. There is almost always a way to use those passive losses. It just takes some sophisticated tax planning from a good tax advisor. And if your tax advisor isn't getting you those passive losses, you may want to consider looking for a new tax advisor.
So if a doctor is working 40 hours a week, is it coming from them or their spouse? That's the real estate professional side.
Maybe that neither one's a real estate professional. Understand that passive losses are not non-deductible. Passive losses are only deductible against passive income. Mm-hmm. So sometimes the key everybody focuses on how do I make the passive losses non-passive? That's great. But let's say you can't. Let's say husband and wife are both, like my wife and I both work full time, right? I mean, we work I can't remember the last time we worked only 40 hours in a week, right? So how do you make those passive losses deductible? Well, what you have to do is you have to change some of your income from active income to passive income. So sometimes the tax planning is about creating passive income, not changing the character of the passive loss. It's the other side of the equation. And you just have to let's look at both sides of the equation. Could I make it non-passive? That would be great. Or can I take active income and make that active income passive? So could I turn my business income into passive income? And there's a lot of ways to do that.
Got it. Got it. So how does like a W-2 employee turn that active into a passive?
Well, you got to have a business.
Got it.
If you're just a W-2 employee, you're basically SOL. I mean, the tax law is stacked against you.
Got it. Got it. Well, cool. I think a lot of people are kind of, their heads probably spinning a little bit. Maybe talk about a little bit about how do people determine if their CPA knows a thing or two. I think we armed them with a little bit of information, but if you were to ask the CPAs one question, what would it be?
It would be, how do I reduce my taxes? I would literally ask them, how do I reduce my taxes? Because you're going to get, more times than not, what answer you're going to get is make less money. Worst answer in the world. Why would you ever want to make less money? So there's thousands of ways to reduce taxes. I'll tell you, on average, when we get a new client, we're reducing their taxes by 10 to 40% within 3 months, on average. Some of them, I have a doctor that he actually showed me, and I mean, I knew this inherently, but he goes, you know, you reduce my taxes the first year by about 50%, but within 3 years, he's going to be to zero. And that's a doctor. And by the way, he's making 7 figures as a doctor, and he's able to reduce his taxes that much. Now, he's very actively involved in investing and reducing his taxes. So there are things that he's doing to make that happen. But the reality is that anybody can. They just have to understand how the law works and take the actions that's necessary to change their facts so that they can get that reduced taxes. Reducing your taxes, it's the easiest way to put, and the fastest way to put money in your pocket. And all that money is now available to invest in more deals, which creates more tax benefits, which lowers your taxes again, which gives you more cash to invest in more deals. And it's just, it just feeds itself. It's amazing.
So you started this, this new company, WealthAbility Network,
yes,
a couple of years back. Maybe tell us a little bit about that. And I think that'll kind of give people an action plan moving forward.
So what we kept having people come to us and say, I keep talking to my CPA. They can't do this. I can't find a CPA. Can you help me find one? And we can only take so many clients ourselves. So what we did was we have developed a network of CPAs. Okay. And we're continuing to develop that network. So by the way, if you like your CPA, but they don't understand this stuff, have them come to us at WealthAbility.com. And I'd love to talk to CPAs as well, because what we're working on is completely revolutionizing the CPA profession, the tax profession, so that as many people as possible, as many CPAs as possible, understand how the tax law really works and then can serve their clients better. But if you want to take the easy out, all you have to do is come to WealthAbility.com and we'll find you a CPA.
Cool. Well, appreciate it, Tom. Thanks for jumping on, and one of these days I'll see you in Texas or something. I saw her last time and sign my book, the new book.
Absolutely. Happy to. Anytime. Happy to be here.
All right, guys. Well, yeah, check out our little tax guide of all different ideas that people in the mastermind came up with. Again, it's not legal or professional advice, but you can check that out at simplepassivecashflow.com/tax. And we'll see you guys next time. Bye.